I'm going to say 4,000. I do think we'll pull back close to 3,000, but if I have to say by year end, I think gold is closer to 4,000. I think instability. I think, again, eventually the economy will continue to weaken slowly, but it'll weaken. And I think that pushes more people into gold. I still think there's risk on gold for a pullback to about 3,050 or 3,000. But this, again, this up move, this is your flagpole, your bull move. This inside parallel is a bullish pattern of consolidation. Even if it comes down here, I'd be buying gold on any pullbacks here for a longer move. And let's be fair, we all know what the government's doing. A new spending bill passed, going to add $3-4 trillion at minimum to the debt. We already are at 37 trillion. Just like Bitcoin longer term, I don't know how you don't like the idea of something other than fiat currencies as a store of value.
Gold appears to be on the cusp of a major move higher, even as recent market focus has centered on silver's impressive rally. Since early June, silver has surged from around $32 to nearly $39 per ounce, reflecting heightened investor interest in hard assets amid mounting macroeconomic uncertainties. In contrast, gold has been trading within a consolidation range. However, according to seasoned technical analyst Gareth Soloway, this should not be mistaken for weakness. Rather, gold is forming a textbook bullish continuation pattern known as a bull flag. Soloway notes that this type of price structure, where a strong initial move is followed by a period of orderly consolidation, often precedes another significant upward leg. While he does acknowledge the potential for a short-term pullback, possibly to the $3,000 to $3,050 range, he views such corrections as healthy and anticipates renewed upside momentum following any dip. The broader economic backdrop is only reinforcing the long-term bullish thesis for gold. The U.S. government's latest spending measures are set to push national debt past $37 trillion, further straining confidence in the long-term stability of fiat currencies. Soloway argues that in this kind of fiscal environment, the case for owning real assets, particularly gold, grows stronger. Like Bitcoin, which has gained traction as a hedge against fiat devaluation, gold offers investors a time-tested store of value that stands outside the traditional monetary system. As inflationary pressures persist and central banks around the world diversify their reserves away from the US dollar, gold is increasingly viewed not just as a safe haven, but as a strategic reserve asset. Meanwhile, the US dollar index, DXY, has recently broken above key resistance, showing short-term strength as interest rates rise. Soloway believes this rebound in the dollar may be temporary, as underlying structural weaknesses in the U.S. economy and monetary system remain unresolved. He sees the dollar's current momentum as a final defensive reaction before more capital flows into gold as a reliable long-term asset. Given these dynamics, Soloway is leaning toward a bullish year-end forecast for gold, with a potential upside target around $4,000 per ounce. He concludes that growing global instability, weakening confidence in sovereign debt markets, and persistent fiscal imbalances are all aligning in support of significantly higher gold prices in the months ahead. Now, we present the clips from Gareth's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I look at Ethereum and I say, essentially, Ethereum is the silver, gold is the Bitcoin, right? Bitcoin is gold. The same sort of thing. You have the catch-up trade. So gold has zoomed up so much in the near term that essentially, eventually, investors say, yeah, I don't really want to pay 3,500 on gold. But look at silver. It's not even at its multi-year high yet. Now it's had a big move up. And I want to show this chart here because this is pretty cool stuff when we go to this chart on silver. Because silver, again, had a beautiful break. So let me walk you guys through this chart. Notice this trend line right here. So we were hovering on silver right in this 34.5 level. High pivot, hit it here, pulled back. Hit it here. Look at how we consolidated and then broke out. And then you got this beautiful bull flag, sideways consolidation above the breakout line. That tells you it's going to go higher. It zoomed higher, but look at where it stopped on a dime. A long-term trend line. This is why we just talked about the NASDAQ, that upper parallel line. Same thing. The power of these lines are incredible. It rejected it. Look at how it rejected it here, 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 here. So in theory or in logic, what would we expect right here? Rejection. And that's what's happening. So short term, it hit its upside target. Not to say that over the mid to long term, it's not going higher. I actually do think eventually it will. But just common sense dictates you should get a pullback here of consolidation on silver, and that's what it's doing. So, like gold, I'm just waiting for the pullback to buy the miners. And you can see here this upsloping trend line. Notice we're starting to break down. That probably tells us we're going to be in for a little bit more weakness in the near term. But having said that, this trend line to this low, two low major pivots, I would start accumulating around $48 to $47 on the miners. I do think they go higher with gold. It's just a matter of short-term break point on a trend line here, which tells me the odds favor a move to the downside, and I'll just be waiting at the next support to be starting to accumulate them.
Okay. Very interesting. All right. Finally, let's take a look at the DXY. Yeah.
Yeah. So
Just
this is a really interesting chart, David, because notice what's happening here. We were in this downtrend. You can see this high matching with these subsequent highs. We've now burst above that. So the dollar is starting to gain a little traction here. And also notice interest rates are also going up. So again, the question is, why are people rushing in to buy the US dollar, but also interest rates are going up as well? I mean, a little bit of an interesting action point here. But the point being is the dollar short term now, again, as long as it holds above this line, favors the upside. And again, that should be respected until proven otherwise. Upside target, I'll give you guys my upside target. See this last major low right here, kind of right in this same level. So I'd be looking for the dollar to get back to about 100 on the DXY. And then once we get in there, that'll be the first test of major resistance. But I think right now we're probably going back to 100 on the DXY. I'm going to say 4,000. I do think we'll pull back close to 3,000, but if I have to say by year end, I think gold is closer to 4,000. I think instability. I think, again, eventually the economy will continue to weaken slowly, but it'll weaken. And I think that pushes more people into gold.
Inflation is once again taking center stage in financial markets, with the latest data showing a noticeable uptick to 2.7%, the first monthly increase in several months. This reversal comes after a steady decline from 3.0% in January to just 2.4%, raising fresh concerns about the persistence of inflationary pressures. According to market strategist Gareth Soloway, this resurgence is more than a one-off event. He points to a combination of contributing factors, including Trump-era tariffs, new policy shifts like mass deportations, and the wealth effect driven by soaring equity markets. With the S&P 500 and major indices near record highs, consumer sentiment is buoyed, increasing discretionary spending on everything from electronics to vehicles. This renewed demand may keep inflation stubbornly elevated, hovering around the 3% mark in the months to come. Soloway adds that while inflation remains contained for now, its stickiness complicates the Federal Reserve's decision-making. Despite mounting political pressure for aggressive rate cuts, some calling for reductions as steep as 300 basis points, the Fed is likely to remain cautious. A modest mercy cut by year-end remains probable, but broader easing could stoke the very inflation the Fed is trying to control. Compounding matters is a notable rise in long-term bond yields, with the 10-year Treasury approaching 4.5%. This move, Soloway warns, reflects growing discomfort in the bond market, where investors demand higher returns to compensate for fiscal risk and dollar devaluation. As the yield curve steepens, short-term rates influenced by the Fed fall, while long-term rates rise. Confidence in U.S. economic management and the dollar's global dominance may erode further, reinforcing fears of a slow, structural de-dollarization already underway.
I do think that the tariffs will have an impact. I mean, especially in all fairness, it's not just tariffs, right? You have the deportations going on. You have farms in this country that literally have no one to pick the crops, and they're going to have to pay a lot more to get Americans to come and pick those crops or automate it, which they're not at that point yet. So that, again, is inflationary on the food system. So it's just a matter of time, but I would argue that today's inflation report didn't really scream Trump's tariffs are having an impact yet. I think to some extent, this emboldens the Federal Reserve. Obviously, the Federal Reserve has sustained a ton of attacks from the administration. But I think Powell, in terms of wait and see, I mean, again, inflation upticking on the year over year, in line on the month over month, it just basically tells us to wait a little bit longer. And especially with the jobs data, I mean, listen, we're definitely seeing some weakness in the labor market, but it's in the underbelly, right? So, for instance, the last jobs report was solid. Even the revisions were not that bad, but the participation rate is starting to come down, which tells you people are dropping out of the workforce because they cannot find work. So, yes, the jobs numbers are solid, solid enough for the Fed to kind of sit on the sidelines at this point. I would expect inflation to continue to creep higher, not just because of Trump's tariffs. There's other factors here. We talked about the deportations having an impact as well, but also I would just point out is that one of the biggest drivers about a year ago of inflation was the stock market, and the stock market was at all-time highs. We had the big correction in March into April. We're now back at all-time highs. So the wealth effect, people are feeling that again. They're feeling well. They look at their 401ks up 25% since April. That's a huge move. That makes people want to go out and spend on goods, for instance, new TVs, etc. And so I think that that can also play a role here. So I think a combination of all those things that I mentioned, you will see inflation continue to hold up. Again, I don't expect a massive spike unless new high tariffs of 30% go into play, but is it going to stay stubbornly around 3% inflation? I actually do think so, and that makes it very tough for the Federal Reserve to cut rates substantially. I think a mercy cut, absolutely. They'll do it by the end of the year, at least one, but we don't just want one, right? The markets are craving, 100 basis points. Heck, Trump wants 300 basis
Mm.
points. We're not going to be able to do that because it would then kickstart a higher inflation. The other thing I'll point out, I want to share my chart if that's okay with you.
Yeah, please.
This is a chart of the 10-year yield. This is concerning, folks. The 10-year yield, even after the somewhat muted inflation numbers, is now pushing up pretty substantially. We're nearing 4.5% again, and that's troublesome. Now, you do have resistance around 4.55, downsloping trend line. That should be a level where it's going to meet resistance. But if yields continue on the long end to push up, that makes borrowing costs higher and a lot of other factors. It also makes the distinguishing factor of investing in stocks versus bonds to be a harder one as you get a bigger yield on bonds over time here. As a trader, I start to get a little concerned, right? Because there's a divergence in essentially what is paid out on the US debt. So 10, 20, 30 years, the bond yields are starting to go higher. The twos, lower are going to go lower with the Fed. And remember, people, the Fed controls the short end. They don't control the long end. Who controls the long end? The market. So what I see is if the long end starts to go up further, let's say we get to 5% on the 10-year, that tells me that in parties like governments around the world that are used to buying the US debt, they're demanding a higher interest rate. They don't believe in the financial structure of the US like they did. The dominance of the US dollar is at risk. De-dollarization is slowly, and I stress this because everyone freaks out that de-dollarization is something that's going to happen overnight. No, it's 10 or 20 years. But again, starting that process, it is starting, it looks like to me, as again, the foundational trust in the US system with the US debt is starting to erode. So these are all things that can drive the long bonds higher. The shorter end, usually, again, the Fed will control, and they will do their best to kind of control it for sure. I love Bitcoin long term, but yesterday we put in what's called a topping tail. A topping tail is where you get a big surge up early in the day. By the end of the day, the sellers have dominated, and they've basically annihilated the buyers and pushed price all the way back in. You can see I annotated this on my chart here, calling it a topping tail. So in technical analysis, if you go to a textbook showing technical analysis, this is what we call a reversal bearish indicator. And sure enough, today, notice Bitcoin actually having a substantial fall. So that's the first thing that just has me as a technical trader on alert here that we did get a daily topping tail. The number two thing is we have to go to our weekly chart and start looking at a longer term trend line that I've been following. In fact, I think the last time we talked, this was a trend line that I was looking at. And basically what we do here is we connect all of our highs from the 2017 bull market, first high of 2021, second high of 2021, and then the 2024 highs into early 2025. Now, we breached that line But as of now, it looks like we're trying to get back below it. You do not want to see Bitcoin have a weekly close back below basically 116,000. That would be a failed breakout, and sometimes the biggest moves come from failed breakouts or breakdowns. In this case, that would be a big move to the downside. So I love the bullishness out there, but also it can be a warning signal when you get the cacophony of insanity where people are calling for 250,000 by year end or even a million. Be aware, I always just look at the charts. The charts give me probability, and right now you've now turned from a bullish move on Bitcoin to now favoring bearish side action. This would be your first level of support. And the reason it is a support level, it's this high pivot to this high pivot and right across, right? So you have a very obvious resistance, 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 resistance breakout. And so on a pullback, the 109 to 108,000 level, that is going to be your first big level. If you get through that, then we start talking about a bigger trend line here that you really need to hold. And this would, again, so you technically could buy at the 108, 109 level if you really believe in this. You could even buy up to about 86,000 right here. This beautiful upsloping trend line from 2023 through 2024 into early 2025. If this one breaks, that's where you would start to be concerned. As long as you hold above this longer term trend, you could say, okay, Bitcoin is holding its longer term 2023 trend. It's still in a bull trend. It's still in an uptrend. If this breaks, that's where trouble starts. But right now, again, 108 to 109,000, that would be your first expected pullback to support.
That's not a huge pullback. That's, an average Tuesday for Bitcoin.
That's true. That's true. And
So
that's the
what
beauty of it, right? Is, I mean, if you're a bull, then you're like, who cares? It's just a pullback. Now, my only caution would be is that you just want to see whether or not this trend line here, this trend line going back to 2017, it just wouldn't be healthy, right? We look at something being healthy when it breaks out, it should hold the breakout. It should have the strength to hold the breakout. If it can't, it just makes you pause a little bit. But you're right. The pullback to 108, 109,000 is just your run-of-the-mill 1 or 2 day pullback in Bitcoin.
The recent rise in inflation is fundamentally shifting market expectations, driving investors toward precious metals like gold and silver as key hedges against declining purchasing power and uncertain monetary policy. With inflation holding steady around 3% and showing signs of increasing, concerns over the stability of fiat currencies and limited central bank flexibility are growing, reinforcing gold's role as a reliable long-term store of value amid mounting government debt and fiscal pressures. While gold consolidates after recent highs, these pullbacks are viewed as prime buying opportunities, especially as real yields remain low compared to inflation expectations. Meanwhile, silver has surged sharply, benefiting not only from inflation-driven demand, but also its critical industrial uses in energy and technology sectors, adding to its appeal. The combination of persistent inflation, weakening faith in fiat money, and rising long-term bond yields creates an ideal environment for both metals to flourish. Share your thoughts on Gareth's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.